welcome to the hour of a special program in Monetary Policy Committee Decision Day. I'm Bosin Namofai. We're live to you from China's global headquarters in Lagos. My panelists today from our Abuja studios, Professor Uche Waleke, who is a chief economist at the SEC and the current chairman of the CIBN in Abuja. Thank you very much, Professor. And also live to us from our studios at the Nigerian Stock Exchange, Victor Chiazo, who is the head of research at FSL Securities Limited. Victor, thank you very much for coming through on our market street for this conversation. And live here at China's global headquarters in Lagos, Ose Ajayi, who is a senior banking analyst at Meristem Securities and the strategist in charge of fixed income. Thank you very much, Victor. And also the Director General of the Manufacturers Association of Nigeria, Mr. Ajayi Kadru. Thank you. We appreciate your coming here, gentlemen. Thank you. Let's have this conversation. Of course, the Monetary Policy Committee meeting today and the decisions will be all that President Buhari will take into his second term in office. The next monetary policy will be sometime in July. So by the time they're done with today, this will be what the monetary policy outlook will be. Of course, if there's any need for the central bank to make additional comments, that will come with today and maybe when God knew in the Mayfele officially clocked the first term in office and going for the second one on the 2nd of June, of course, effectively 3rd of June, which is a Monday. So let's give you this. And Professor Waleke, let me just read this very quickly. As part of the communique of the March 26th MPC, part of what the governor read then as part of the committee was this. It says, on a more cautious note, the committee expressed a concern and sympathizes with the fiscal authorities over the growing fiscal deficit, external debt, and debt service, and urge the fiscal authorities to monitor the public procurement process also in order to improve efficiency in public resource management. This is a very heavy statement from the Monetary Policy Committee when talking about procurement, fiscal deficit at the federal and at the subnational, what you call state level. All of these are very heavy. Do you think anything has changed significantly since March?
Yes, I think you wouldn't say there has been a significant change since then. But what I also know is that of recent, the federal government sought approval to borrow, I think, about $1 billion, and the money is supposed to be for the hydropower. So I don't see anything wrong in borrowing and tying it to projects. Of course, the fiscal imbalance is a source of worry to the central bank because the more the government borrows, particularly domestic borrowing, that tends to crowd out, private sector. And if the government is competing with the private sector for funds, of course, that will be driving up, interest rates. So I think the central bank has a cause for worry, and the MPC also talked about, as part of the risks, the likely risks to inflation, the delayed implementation of the 2019 budget, because of course when it's delayed and the implementation is not phased over a period of time, that could have adverse implications for liquidity, and then put the central bank in a position to also begin to use especially the OMO instrument, to mop up, which has proved very expensive, for the central bank. But earlier on I said my prediction is that it will be a hold decision. But of course, what I would have wished, if I were a member of the MPC, would be to also further, reduce the rate, because in March it was clear that the central bank signaled a new direction of monetary policy. And I think we are in a position to do that now, given the volume of our reserves that we hear has hit $45 billion, enough to finance over 10 months of merchandise imports. So the exchange rate has been stable and the oil price is doing well. So I think this is the time to see how we can ease monetary policy a bit to support growth, in view of the fact that even the first quarter GDP results that we saw, is still tepid, at 2.01%. So for me, I was also saying earlier on that from the personal statements of many of these MPC members, you could see a disposition to be dovish about monetary policy. The last MPC, in particular, Edward Adamu and Festus Adiola, including Aisha Ahmad, emphasized the need for the central bank, to pursue pro-growth policies. And that was why even Aisha Ahmad had even voted. She was the only person that voted that the MPR be dropped by 100 basis points, from 14 to 13. Eventually, the guys that said 50 basis points.
Professor Waleke, so just a quick one there. We need to just hold that. Thank you very much. Very quickly, respectfully, the Central Bank Governor, Godwin Emefiele, is set. He's there with the other members, so we need to go live to the Central Bank of Nigeria's headquarters to take the governor of the central bank's comments. He should be ready in about a minute or so from now. But very quickly, Professor, if we take some of what you said about the government borrowings and putting about $1 billion in the hydropower and all of that, I'm sure that's music to the ears of the Director General of MAN, who needs all the power he can get in his factories to get the production running. Looking at our manufacturing, very sluggish performance of less than 1/4 in first quarter of this year. You need that more. You can use $1 billion.
Absolutely, certainly.
Yes. So you think this borrowing from the World Bank, whatever, will help? You think if we saw the power? I was asking whether interest rates is a major issue for you.
Yes, it is a major issue. And even though one should be worried about borrowing, or if it's targeted at funding productivity, the multiplier effect for the economy will be high. And like I said the last time I was here, the manufacturer's CEO did indicate that supply of power to our industry still remains the #1 challenge. So every effort of government focused on getting us out of this serious problem will be a welcome development.
The central bank is also tackling a number of issues, including smuggling, whether it is in agricultural products or textiles and rice and what have you. You think these are steps in the right direction, Director General?
Yes, they are steps in the right direction. If you take the iron and steel, for instance, the heavy influx of roofing sheet has virtually killed that sector. And I can tell you that it's partly responsible for the challenges that the WEMCO group is having. If you see all over the country, our companies in the steel sector are on the verge of collapse. Camwire, SMC, name them. All of them are groaning under the onslaught from smuggled goods. I mean, it has been put in the newspaper. We have spoken to government about it. And it's about time that serious action is taken. Otherwise, just like President Muhammadu Buhari said, that if we don't kill corruption, corruption will kill us. If we don't kill smuggling, smuggling will kill us.
Very interesting. Let me ask just about a minute. We're all on standby for the central bank chief to start reading the communique of the monetary policy two-day meeting. But very quickly, also, Ajayi, in terms of what you think, we've seen a very, very strenuous defense of the Naira, using OMO, trying to help the government balance the books, as it were. It's not as good as everyone thinks. It comes at a very high cost, as has been said earlier. What's your view on that? This is likely to going to continue. Yeah,
we've taken on so much borrowing in the recent past, and then I don't see that stopping anytime soon. I mean, the debt management...
Okay, I think the central bank governor, sorry, also, let's listen to the governor of the Central Bank of Nigeria, Godwin Emefiele.
The Monetary Policy Committee met on the 20th and 21st of May 2019 amidst uncertainties in the global financial, economic and political environment. All 11 members of the committee were present. The committee reviewed developments in the global economy, noting with concern the declining trend in global output growth, which commenced in the second half of 2018. Accordingly, the International Monetary Fund downgraded global output growth from 3.7% in 2018 to 3.6% in 2019, and further revised it downwards to 3.3% in 2019. The decrease in the Global Composite Purchasing Managers Index, PMI, in the last 3 months provides further fillip to this downgrade. The committee noted that the weakening global output growth continued amidst prevailing uncertainties from familiar headwinds, including the further escalation of trade tensions between the US and China, imposition of new rounds of sanctions on Iran, breakdown of Brexit negotiations, a new wave of tension on Korean Peninsula, vulnerabilities in major financial markets, and rising public and private debt in some emerging market and developing economies. Despite these uncertainties, inflation in the advanced economies remain muted and largely below their 2% long-run targets. As a result, most central banks in the advanced economies, including the Fed, the Bank of England, and the European Central Bank, adopted a dovish monetary policy stance, which is expected to remain in place in the near to medium term as signs of weakness in the global economy re-emerged. In the emerging markets and developing economies, however, developments were mixed, with inflation rising in some, but moderating in others. In response, the financial markets witnessed the rebalancing of portfolios from equities to fixed income securities, and some stock markets posting losses. In the main, the emerging markets and developing economies are expected to continue to benefit from the accommodative monetary policy stance of the advanced economies through increased capital flows. The domestic output developments. Available output data from the National Bureau of Statistics, NBS, showed that real gross domestic product, the GDP, grew by 2.01% in the first quarter of 2019, compared with 2.38% and 1.89% in the previous and corresponding quarters of 2018. This was largely driven by the non-oil sector, which grew by 2.47% in the first quarter of 2019, while the oil sector contracted by 2.4%. Staff projections indicate that real GDP growth of 2.34% and 2.36% during the second and third quarter of 2019, respectively, including a reduction in the unemployment rate. The Monetary Policy Committee observed that actual output remains below potential, implying that the economy still had sufficient headroom for inflationary growth. This is expected to be driven largely by sustained stability in the financial system, continued special interventions in the agriculture, manufacturing, and the SME sectors by the bank, sustained effort in improving transport infrastructure to address distribution challenges, continued expansion of business activities as indicated by the PMI, and increased supply of foreign exchange to growth-stimulating sectors, among others. The committee noted the continued expansion of the manufacturing and non-manufacturing purchasing managers indices for the 25th and the 24th consecutive months in April, and broadly welcomed this positive development in the economic activities in Nigeria. The manufacturing PMI grew by 57.7 index points compared to 57.4 index points in the previous month. Similarly, non-manufacturing PMI grew by 58.7 index points compared to 58.5% points in March 2019. The growth in both measures of PMI were anchored by marginal increases in production, employment level, and new orders. Developments in money and prices. The committee noted the growth in broad money supply, M3, by 5.42% in April 2019 from the level at the end of December 2018, annualized to 16.36% above the indicative benchmark rate of 14.47% for 2019. This was largely driven by the growth of 19.62% in the net domestic credit NDA, and in contrast, net foreign assets contracted by 5.83% in April 2019 relative to the level at the end of December 2018. In spite of the significant underperformance of the M1 at minus 4.26% annualized to minus 12.77%, M2 grew by 1.85% in April 2019, annualized to 5.54%, which was significantly below the benchmark rate of 12.99% for 2019. This development was largely due to the growth in time and savings deposits by 6.53%. The net domestic credit NDC grew by 19.31% in April 2019 from the level at the end of December 2018, annualized to 57.92%, and was above its indicative benchmark of 11.82%. The growth in NDC, net domestic credit, was attributed to the significant increase in credit to both government and the private sector by 64.4% and 9.6% respectively in April 2019, compared with December 2018. The committee noted the developments in the monetary aggregates and enjoined the bank to initiate moves towards improving lending to the private sector and urged other intermediary institutions in the financial sector to support these initiatives by improving their credit delivery to boost output growth. The committee noted the uptick in inflation as headline inflation rose slightly to 11.37% in April 2019 from 11.25% in March 2019. The increase in headline inflation was driven mainly by food inflation, which rose by 13.7% in April 2019 from 13.45% in March 2019. Core inflation, however, declined marginally to 9.28% in April from 9.46% in March of 2019. In April 2019, month-on-month inflation headline food and core inflation increased to 0.94%, 1.14%, and 0.70% from 0.79%, 0.88%, and 0.53% in March 2019, respectively. The Monetary Policy Committee noted that the recent uptick in inflationary pressure was seasonally driven and anticipated. Liquidity conditions in the banking system reflected the net impact of the open market operations auction, maturing CBN bills, statutory allocations to states and local governments, as well as interventions by the CBN in the foreign exchange market. Consequently, the monthly weighted average interbank call and open buyback rates increased to 13.98% and 16.15% in April 2019 from 10.8% and 12.17% in March 2019, respectively. The daily unsecured interbank and the open buyback rate fluctuated within the standing facilities corridor, closing at 6.57% and 5.55% on May the 10th and May the 16th, 2019, respectively, reflecting the reaction of the money market to the 50 basis points reduction in the policy rate at the meeting of the MPC in March of 2019. Committee observed the continued bearish trend in the equities in spite of the sustained capital flows into the economy during the period under the review. The all-share index declined by 8.14% to 28,871.83 index points on May 17, 2019, from 31,430.5 index points as at the end of December 2018, while market capitalization grew by 8.53% to 12.72 trillion on May 17, 2019, from 11.72 trillion at the end of December 2018. The recent growth in market capitalization reflected new listings in the market, prominent amongst which is the MTN and Skyways Aviation Handling Company PLC, and additional listing from the merger between the Access Bank and Diamond Bank. The committee welcomed continued stability at both the Bureau d'Echange BDC and the investors and exporters windows of the foreign exchange market, expressing optimism in the recovery of crude oil prices due to the OPEC production ceiling and other geopolitical issues affecting oil exports. The NPC also noted the steady accretion to external reserves, which stood at $45.42 billion as at May 16, 2019, an increase of 2.2% from $44.44 billion at the end of April 2019. The overall outlook and risks. The overall medium-term outlook for the global economy remains mixed and uncertain, with growing indications of persistent macroeconomic vulnerabilities, global financial markets fragilities, accommodative monetary policy, policy uncertainty, and weakening global output. Data on the domestic economy suggests some fragility in output growth during the second quarter of 2019, with improved outlook for the rest of the year. Accordingly, revised output projections indicate that the economy would grow by 2.1% according to IMF, 2.2% by the World Bank, and 2.38% by the Central Bank of Nigeria in 2019. This outlook is hinged on the following key factors: the effective implementation of the Economic Recovery and Growth Plan, ERGP, supportive monetary policy, enhanced flow of credit to the real sector, sustained stability of the exchange rate, and improved fiscal buffers, among others. Committee thus expects that monetary policy will focus on improving access to credit, reducing unemployment, and stimulating economic growth. Committee's considerations. The committee took into consideration the continued slowdown in the global economy and the persisting uncertainties, including the ongoing trade wars between the U.S. and its major trade partners, financial fragilities in a number of countries, the debt-constrained fiscal operations of the most EMDs, including Nigeria, and the volatility in on the oil market. Committee therefore enjoined the federal government to urgently build fiscal buffers through a more realistic benchmark oil price for the federal budget. The MPC noted the 2.01% growth in real GDP during the first quarter of 2019, compared with 1.89% in the corresponding quarter of 2018. Although output growth in the first quarter was slower than 2.38% recorded in the preceding quarter, it emphasized that actual output remains well below the economy's long-run potential, indicating the existence of spare capacity for non-inflationary growth in the economy, an opportunity which should be explored through increased credit delivery to the private sector. Not impressed by the flow of credit from the deposit money banks to the private sector, the MPC called on the CBN management to urgently put in place modalities to promote consumer and mortgage lending in the Nigerian economy, noting that doing this will greatly and positively impact on the flow of credit and ultimately result in output growth. The MPC called for a close monitoring of the uptick in inflationary pressures in April 2019, driven largely by food shortages during the Easter season, the commencement of the planting season, as well as persistent security challenges in some of the food-producing regions of the country. The committee urged the relevant authorities to strengthen efforts to address the security challenges and improve food production. It encouraged financial intermediating institutions to ensure that loans to the agricultural sector were channeled effectively to end users. The MPC welcomed the improvement in financial soundness indicators, but noted that although the non-performing loans ratio moderated, it remained above the prudential benchmark. Consequently, the committee considered and recommended to management a proposal to develop a comprehensive administrative, legal, and regulatory framework to speed up the recovery of delinquent loan